Hi, everyone. Good afternoon. My name is Salim Boutagy. I'm a partner here at Moneco Advisors, and thanks for joining us today as we present financial strategies for the small business owner. So our webinar today will be recorded. As we go through the agenda, you'll see that I've reserved some time at the end for Q&A. There's a chat box in the Zoom meeting window. If you have any questions throughout the webinar, please be sure to drop your questions in that chat box and I'll get to them at the end of the presentation. All right, I'll dive right in. So the goals for the presentation today, I know small businesses and business owners, questions on business owners' mind can be aplenty. My job is to hopefully keep the conversation today high level, the topics easy to understand, although some of them will be complex, certainly around things like tax planning strategies. But today we're going to review what the business owner's financial landscape looks like. We work with a lot of business owner clients here at Moneco, and we have a very good sense of what that is, and we're very attuned to the small big business marketplace. I think on everybody's mind, not just business owners, but other clients as well, they're always concerned about asking about tax strategies. So we'll be certain to talk about that today. I think another big part of small business owner financial planning is succession and exit planning. We'll talk about that today. We'll have a general conversation around wealth and risk management. I'll share an interesting stat for the topic of conversation today around risk management for small business owners. I'll give everybody a action plan or certain things that they could do right out of the gate to perhaps improve their situation or improve future outcomes. And like I mentioned, there's some time at the end of the presentation for some questions and answers. So, as I mentioned, Moneco Advisors, we've been around for a long time. We have a lot of different clients. Small businesses and business owners are one of the types of clients that we work regularly with. And we do know some of the unique challenges that small business owners face. I think one of the biggest challenges, not tax related, but just generally related to business owners, is that the business that you own and have worked in for a long time, or maybe not, is your biggest asset. And with that comes some risk because of concentration. Key stat, 78% of small business owners' total net worth is tied up in the value of their business. So the other challenge too that is unique to business owners is wearing too many hats. Business owners usually start out maybe as a sole proprietor, and as a result, they have to wear a lot of different hats. As they grow and scale the business, sometimes they don't often delegate some of the things that they were doing, or it might be too expensive to hire key personnel to do things within the business. So that many hats challenge sometimes grows with the scale of the business. And I think, unfortunately, in many instances, certainly for the folks that we're introduced to, there's no written financial plan for business owners. And a written financial plan is going to help address a lot of these challenges and certainly that risk that the business owners have in the concentration of their net worth. So when we look at working with small business owners, we take a financial planning approach as a firm, and we have an approach that we call the 5 pillars for financial planning for business owners. One is somewhat related to tax and risk management, and that is optimizing the business structure, S Corp, LLC, partnership, C Corp, things like that. We help advise our clients on the best structure. We'll talk a little bit more about that as we progress through the conversation today. Just like anybody, cash flow is really key. So helping business owners manage their business cash flow and their personal cash flow is key. But somewhat tied to the business entity structure is how do you compensate yourself? What's your strategy around compensation for yourself and for your employees? I mentioned taxes earlier. Tax minimization key for everybody, business owners and non-business owners alike, and that's a key pillar for financial planning for business owners. Number four, this addresses that risk that I mentioned earlier, which is that concentration risk of the value of your business being a big part of your net worth. So in working with business owners, we want to make sure that we are addressing other aspects of financial success, like, for example, retirement planning and just general wealth accumulation outside of the business. And then what's on a lot of business owners' minds at any point in the business's life cycle is, how do I exit the business, or what would that look like? What kind of succession planning should I do? Should I do an internal sale to employees? Should I put my business up for sale in the broader marketplace? Should I transfer this business to my family? And it's really key to do that early on, and we'll talk more about that as we go here. So these represent the five pillars of financial planning for business owners. And we believe that this is the way that you're going to address and mitigate a lot of those risks that I mentioned earlier. So, unfortunately, and I think this is, I think this is probably true for most people, certainly business owners, but particularly business owners, in that there are a couple of different costly mistakes that we find from time to time when working with our business owner clients. One, and it's sometimes glaringly obvious, is that there's no separation between the business finances and the personal finances. It's really easy to run personal expenses through the business for obvious reasons, but that creates sometimes a messy situation, and one that's difficult to untangle, especially when there's an exit or exit planning that's on the horizon. I think the other thing too that we find is that there's really some low-hanging fruit from an employee perspective, and certainly from a tax perspective, in that we don't see a lot of business owners fully utilizing the retirement plan options that are available to them. I mentioned succession planning, so there's a lot of aspects to succession planning, but one of the easiest things to typically put in place would be a buy-sell agreement, and we often don't see those in place early on when they should be there. Tax planning, we mentioned. I think tax planning is key. It's key for everybody, certainly for business owners. But if you wait until the end of the year to do your most meaningful tax planning, you're putting yourself under some pressure to get a lot of big stuff done in a short period of time. So you want to incorporate tax planning as part of the ongoing planning conversation. And then another thing too, that I think I find often when working with business owner clients, is that there's no key person insurance. And that's something that you don't want to have to deal with if it were to occur. And we'll talk a little bit more about that as we progress here today. So like I mentioned, tax planning is year round, and you do want to do this as part of your ongoing planning as opposed to all at once or at the end of the year. I mentioned earlier, what's the best entity structure for your business? Should you have an S corp? Should you have an LLC? Should you have a C corp? These questions are important. It really does depend on your particular set of circumstances. Each one comes with tax related ramifications and considerations. S corps and LLCs, for example, are pass-through entities. S corps have very specific rules, sometimes written, sometimes unwritten, or guidelines around compensation for the business owner. So these are important things, and you want to make sure that not only is this being discussed prior to forming your business, but is reviewed throughout the year. Sometimes people change their business entity structure for a variety of different reasons. The other is, for those pass-through entities, for example, are you maximizing the qualified business income tax deduction? This is something that's been around for a while. I'm sure a lot of people are taking advantage of it, but just make sure that that you are aware of it. If you aren't already, I'm sure you are. But if you are looking for ways to maximize it, doing tax planning early and often gives you that opportunity. The timing of income and deductions, doing that strategically, definitely a tax-related impact. So if you're incorporating tax planning as an ongoing part of your planning, then you'll be able to address that. And I think the other thing too is just keeping good books and records, right? I mentioned no separation between personal expenses and business expenses. You can see how having a home office or other related deductions it's better to just kind of have an organized plan around those things as opposed to waiting until the end of the year when you're trying to segment or identify how much time you spent here versus how much time you spent there. How many miles did you drive for business and how many miles did you drive personally? Being at the tax time and having those conversations or doing that research is certainly a challenge. So incorporate that into the year-round planning. So I mentioned retirement plans. Now, I think retirement plans are one of those things, like I mentioned, that are underutilized. And retirement plans for small businesses play, I think, two key roles within a business. One, I think importantly, is retirement plans are for the employees. There certainly are some benefits to the business and the owner with a retirement plan, but they're really for your employees. And having a retirement plan in place, I think, allows for two things with regards to your employees, and it's particularly important as you think about growing your business, which I hope is a goal of yours. One, it retains employees. It gives them an opportunity to kind of be tied more directly with the business. If you have a 401k, for example, with a profit sharing component, it aligns your incentives, the employee and the owner. I think it does a great job attracting talent as well. Now they're much more prolific. A lot more businesses have them than ever before, even though that they are underutilized. And so if you're in a competitive situation with a key employee and you've made an offer, that employee is likely going to choose a more kind of robust compensation structure, one that may include a retirement plan, for example. So having a retirement plan in place for your employees to retain and to attract talent is key. But the truth is, they are a powerful tax strategy, like I mentioned, and are unfortunately underutilized. There's three main retirement plans available to businesses. There's a lot more than this, but the basic ones for small businesses are SEP IRAs, 401ks. They could be a solo 401k if you're a sole proprietor, and a defined benefit or cash balance plan, just another word for a pension. So from a tax perspective, you can see, and I know there's a lot going on here on this chart, you can save up to $300,000 at the most, or you can defer that amount of your income. That is a tremendous amount of tax savings if you think about otherwise paying taxes on that income if you were to receive it. So if you set up the plan in the way that works best for your unique circumstances and fully maximize what's available to you, not only do you get powerful tax savings, but you also are able to attract and retain key employees, which will help you grow the business further. This chart that you see here, like I mentioned, this meeting is going to be recorded and stuff. I can separately send anybody this chart if they're at all interested, and just having it as a quick reference guide. But I mentioned things like a profit sharing plan, really, really key. A lot of these plans can be customized and designed to your unique business circumstances. So I mentioned succession and exit planning, and a big part of that is understanding what is your business worth. And it's really hard to determine what your business is worth. Like anything, the business is worth what somebody is going to pay for it, right? There are a couple of different ways, though, that you can feel comfortable or confident in knowing what your business is worth using basic valuation practices, like, for example, understanding what your multiple of EBITDA is. You can do that by benchmarking if you have a business in an industry that is fairly robust, and there's other businesses within your industry or category. You can get a pretty good sense of where your value is relative to others if you know that businesses within your industry have a certain multiple of their EBITDA. And there's other ways to value the business as well, too. So when you think about what your business is worth, it's typically to prepare for or plan for an exit. And how does that work? And I mentioned this before. There's a couple different ways. There's an internal transfer you can sell to employees, and you can do that using something like an employee stock option plan. You can also sell into the marketplace, or you can transfer the business to your family. Regardless of what you choose, regardless of what your business is worth, planning well in advance of that exit is key, not just to make sure the deal is done and done successfully, but you can address the taxes or the tax ramifications. A large portion of the value of the business is likely going to be taxable to you as capital gains. And with an aggressive tax planning that's takes into account multiple years of planning or foresight, you can do your best to help mitigate and or avoid the taxes around the business sale. Just like tax planning is an annual thing and it should be done throughout the year, exit planning is something that should be done hopefully well in advance of the target exit. 3 to 5 years is conservative, but I do believe that you should be thinking about this as early as the business is formed, honestly. Okay, so moving along, we're talking about a buy-sell agreement. So I mentioned this before as a common pitfall. A buy-sell agreement is an agreement that you have typically within the business, whether that's with your business partners or maybe with a key employee, that specifies how the business or the shares interest of the business are handled in the event of certain triggering events. One of the more common trigger events that a buy sell protects against is death. So, for example, let's say you and your best friend enter into a business venture. You've known each other for a long time and you're really good friends and you're 50-50 partners. The ownership of the business by your friend and business partner, if they were to die, transfers to their estate and through their estate to their beneficiaries. So in order to allow for that interest to continue on within the business, a good and well drafted buy sell agreement would account for something like that happening and probably have, let's say, for example, life insurance proceeds paid to your partner's family or estate as opposed to shares of the business. That way you can kind of keep the business going through such a dramatic shakeup. But there's other common trigger events, again, using that same example, 50-50 partners, you and your best friend from college or whatever. What if one of you becomes disabled? Or if what if one of you becomes divorced? You don't want the business asset to be divvied up in the divorce proceedings. Unfortunately, it's very common and those things can get quite messy. Or maybe one of the business owners decides it's time to move on, or they found another opportunity elsewhere. So a lot of really common trigger events that happen all the time. And I think a buy sell agreement is prudent planning. I mentioned the interest of the business being funded, or a buy sell agreement being funded with life insurance. It's a very, very common practice. It's utilized often. On the bottom right here of this chart, we talk about the different types of life insurance used in a buy sell agreement, whether that's cross purchase or entity redemption. Very, very technical and detailed. I think more technical than this conversation today, but this will be shared if you're interested, along with the other chart. So a lot here, but just know, I think at the basics, a buy sell agreement is absolutely critical for prudent planning if you have one or even multiple partners or even owners. And the more owners, the more complex, the more necessary a buy sell agreement is. Okay. The other thing I wanted to focus a little bit on today, and I mentioned this before earlier, was how should you pay yourself from the business. Now, a lot of times business owners are either sole proprietors or they have an LLC where they're the only member and it's a pass-through entity for tax purposes. It's really easy to pay yourself out of that because you're basically taking anything that's left over after expenses are paid against your income. But as your business grows and perhaps your structure changes a little bit, for example, if you have a S corp with multiple owners or multiple employees, how you pay yourself is key. With an S corp, for example, a portion of that compensation should definitely come through W-2, and a portion should come through distributions of profits. So I think that understanding these things and getting it set up and reviewing them is absolutely key. And that addresses kind of what I mentioned earlier with regards to tax planning. But the other thing is if you are taking profits, if your business is successful and you're able to kind of build your wealth outside of the business, that would be one way that you're able to address that concentration risk that I mentioned earlier. So through prudent cash flow planning, through conversations with your advisors, you can determine what is the right amount of money to reinvest into the business what's the right amount of money to start accumulating outside of the business so that you can start doing some other things like retirement planning, college savings if you have kids, and things like that. That helps you diversify over time away from the business being the largest part of your net worth. And like I mentioned before, 78% of business owners have the majority of their net worth tied up into their business. So getting ahead of it, planning for it, addressing it by accumulating assets outside of the business is a good way to avoid the pitfalls of having that business be a big part of your net worth. So because the business is such a big part of your net worth, protecting what you've built is key. And I mentioned a couple of things that you can put in place to protect yourself. Things like key person life insurance, I mentioned, that's a key way to protect the business. Buy sell agreements I talked about. Other things that you can do to protect yourself or protect the business, which is likely a big part of your net worth, is to get business overhead expense coverage, disability income protection for the owner. I think disability insurance, unfortunately, is underutilized across the board, not only for business owners, but really for everybody. So reviewing that, making sure you have a good, solid plan in place for that. Um, and then I think there's other parts of protection that you can utilize insurance for besides disability insurance, things like making sure your personal liability protection is where it needs to be, utilizing things like an umbrella liability insurance policy would be absolutely key, excuse me, to further protect yourself. All right. The other thing I think too that I mentioned was financial planning for small businesses. So we laid out the 5 pillars of financial planning, the things that we want to make sure every business owner has in place for their financial plan to be successful. This provides a little bit of a roadmap to implement sometimes the plan over time. And with anything, you plan, I think, linearly, and you do things that are easy to accomplish first, and then you build from there. And this roadmap gives you a sense of what I'm talking about. So there are things that you can put into place today and start out with that would make really dramatic impacts and are relatively easy to implement. Those things are making sure you have the right business entity. We talked about that, making sure you're utilizing and fully optimizing retirement plans, and making sure you have a buy-sell agreement in place. These are really easy things that you can do, and you should start off with these things first. As you build upon that, you move into maybe identifying areas where you can be a little bit more tax efficient, even beyond a retirement plan. There's a long list of other things that you can do to be more tax efficient. You can start building that wealth that I mentioned outside of the business to address the concentration. You can better manage your cash flow. And so you build progressively upon that each year to build a solid retirement plan, one that protects you and your business, your net worth, and the value that you've worked so hard to create, and to prepare yourself for either a successful exit, a transition to a new business, or a successful retirement, whatever that may look like. Once you've fully optimized all of the base building blocks of financial planning for business owners, if you're fortunate enough to build a considerable amount of value within your business, you can start doing some estate planning. If you're philanthropic, if you're charitable, you can start having a well-crafted philanthropy or philanthropic goal plan. So there's a lot of things that you can do, but it starts first with the basics, the foundation, the solid foundation, and building upon that. And so our relationships with our clients are exactly that. We are the ongoing advisor, and we're using this roadmap to help guide our clients to the ultimate destination. I think there's a couple of things that you start off with: protecting and preserving, then optimizing, then building, then exiting. And that's what this roadmap lays out for you. This, like the others, are available if it is available if you'd like to see it. And this is really what that looks like in graphic form. So this is how we work with our business owner clients. And I mentioned this just briefly. We have that roadmap I mentioned. But for folks that are coming into conversations with us, we start out getting to know them and understanding their circumstances, collecting a lot of information from them. Then we build that financial plan and we implement it. And implementing a financial plan depends on unique circumstances, but for example, implementation might look like helping you, or at least helping you find an attorney that can draft a buy-sell agreement. And then the ongoing relationship is really where the magic happens. That's where we're able to take our clients through that life cycle of their financial, or sorry, of their business, and really being a partner with them in a way as their financial partner. I would say the business owners that we work with have a lot of different professionals that they already work with. They have a CPA, they have an attorney, they may have an insurance professional, life insurance professional, health insurance, whatever, the list goes on. The key is for us to help you coordinate all the various aspects of your financial life within one plan. And the way we're able to do that is by getting to know all of the professionals that are involved and helping coordinate conversations. Or if those professionals aren't part of your team, we can build that professional team out for you by either making recommendations or referrals, or even offering some of those services internally. For example, Moneco does have a tax arm where we offer tax prep and tax advice. And we work with our clients in a transparent and fee-only structure. We are a registered investment advisor, and we have a fiduciary duty to our clients. So that's everything for today. We covered a lot, and I really intentionally wanted to keep it high level. And I would be more than happy to answer any questions that you may have. Let me just check the chat to see if any have come through. Just bear with me here. Okay. So I do have a couple questions that I'd be more than happy to answer. So question is, a lot of business owners don't have, or have a lot of their net worth tied up in the business. How do you typically recommend somebody to start diversifying away over time without hurting the business? Okay, that's a good question. I addressed a little part of it, but I didn't address it to the extent that the question was asked, which is you don't want to hurt the business, right? You have money coming in, you have a decision to make when you have profits. Do you reinvest the business? Sometimes you need to hire another employee or something like that. But how do you do so successfully without harming the business? So I think early on, it certainly does make sense for business owners to invest into the business. Um, you have to, truthfully, because the business is growing, and in order to scale, you have to reinvest. But over time, and I mentioned this early, you really do want to build those assets outside of the business. And you can do things like, for example, like I mentioned, open retirement accounts, maybe have an investment account, maybe build up some real estate, um, real estate investments, um, cash reserves, and things like that. So it depends, but I would say you'll probably know it when you get there based on cash flow, when you probably have an ability to either invest more heavily in the business or to build your net worth outside of the business. It's going to be a balance, like I said, but you're going to want to do it to address that concentration risk. Next question. For small business owners, 5 to 15 employees, how do you usually decide between a SEP IRA, a 401k, or a more advanced retirement plan like a pension plan? So good question. I think it also depends. Unfortunately, that's an answer you're going to hear me give a lot in this business. But the truth is, the size of the business, the consistency of the income, truly how many employees, how much the employees are getting paid, what the employees' ages are, what the employee's ability to contribute is, what the company's ability to contribute beyond what the employees contribute. There's a lot that goes into the mix. And whatever it is, the right plan will find itself. And like I said, the plans can be optimized for your unique circumstances. Typically, though, for a small business owner like one or two employees, a solo 401k is very attractive. It gives you the ability, I think, to save the most that you're possibly able to save compared to a SEP IRA. There are some added administrative requirements, but I believe the added administrative requirements and sometimes cost is beneficial in that you can save more money into that retirement plan. So I typically advise and would recommend a solo 401k for smaller businesses. Don't let the name fool you. Solo 401k can be for one or even a few employees. And it looks like we have one more question here. Okay. Okay, this is a good one. I think this is something that I spent a little bit of time on. So the tax planning being year round, something I mentioned is key to stay ahead of certain things and avoid any mistakes. Certainly take advantage of everything that's available to you. What are a couple of the most common missed opportunities you see from business owners who only do tax planning in Q4? Yeah, so this is unfortunately very common, and I think it's not just for business owners, but for individuals as well. They wait until tax time or the end of the year to do some tax planning. So it's very, very common. Um, Honestly, and I'll go back to things I mentioned earlier, retirement plan contributions. A lot of business owners I work with know or have retirement plans, but they wait until the end of the year to make large contributions to the retirement plan. If you do some cash flow planning and you get a pretty good sense of what you can expect and what your expenses are, you can get ahead of those things and you don't have to wait until the end of the year to do that. I think entity structure reviews, those are missed opportunities, like I mentioned. A lot of business owners do have to make estimated tax payments. So, making those payments early on or when they're due is absolutely critical, and that ties directly into cash flow planning. And then, like I mentioned earlier, like the timing of income and sometimes your deductions, waiting until the last minute to do those things, just it's going to be make it more difficult. So staying ahead of that, getting ahead of that, making sure you have a plan around that is going to drive ultimate success. So that's everything. And I want to reshare my screen with you again real quick um, to share my contact information. So if you are interested and want to explore this further, or you want some of those graphs and charts that I mentioned in the presentation here, please feel free to reach out to myself or to anybody here at Moneco Advisors. You can call me directly at 203-493-4492, or you can send me an email at salim@monecoadvisors.com. Very, very happy to schedule a complimentary financial plan review or business financial plan review. And that's all it would be in the first meeting. It's just an opportunity for us to get to know each other, for me to answer any questions that you have, and to give you a sense of what I think would be the best next step. If you refer back to that chart that I showed earlier, it's probably going to be in those kind of low-hanging fruit key areas, like, for example, a buy-sell agreement or a retirement plan. So if anything is like that is on your mind, or if you have any additional questions, do not hesitate to reach out. Thanks everyone for joining. Like I mentioned, this meeting was recorded. It will be shared. And if you have any additional questions or would like any additional information, don't hesitate to reach out. Have a great day. Take care.